Welcome to The Explainer. Let's just jump right in, because today we are tracking what has to be one of the most fascinating, absolutely wild dual-track narratives in modern financial history. We're talking about the story of cryptocurrency. Now, on one hand, this is a story of incredible, totally unprecedented financial highs that literally rewrote the rulebook on investing. But on the other hand, it's a dark story of devastating criminal lows, massive complex frauds, and underground black markets. So we are going to unpack exactly how this fairly obscure digital experiment morphed into a trillion-dollar asset class, and of course, look at the absolute chaos it left in its wake.
Now, to really grasp the sheer gravity of this market, just think about this number for a second. 1,900%. That staggeringly high figure perfectly captures the raw, explosive power of the 2017 Bitcoin bull run. I mean, imagine tossing $1,000 into an asset in January and then watching it skyrocket to nearly $20,000 by December. That kind of staggering, face-melting growth is exactly what dragged cryptocurrency out of the internet shadows and slapped it firmly onto the front pages of mainstream media everywhere. It minted overnight millionaires and set off a global frenzy.
But, well, what goes up has to come down, right? The euphoric matic cycles of crypto have routinely collided head-on with some incredibly bad actors. So it really begs the question, what actually happens when these massive financial bubbles burst? What happens when you have billions upon billions of dollars sloshing through systems that have virtually zero regulatory oversight? To really understand the true dangers baked into this ecosystem, we have to go all the way back to the beginning.
Section 1. The Wild West and the Rise and Fall of Silk Road. You know, long before Bitcoin was sitting pretty in traditional Wall Street portfolios, it was basically the currency of the internet's underground. This era was its first major collision with federal law enforcement, and it completely set the stage for how the entire world would initially perceive crypto.
Let's make sure we're on the same page about what we're actually dealing with here. A darknet market is essentially an online black market hosted on the dark web, where users can buy and sell products completely anonymously. The most infamous of these, hands down, was the Silk Road. It was launched back in 2011 by an American named Ross Ulbricht, who went by the online pseudonym Dread Pirate Roberts. Now, Ulbricht was known for his strong libertarian ideals, and he built this marketplace to function entirely outside the reach of government oversight. He used the Tor network to guarantee absolute anonymity, and of course, he used Bitcoin to process totally untraceable payments. The sheer volume of this whole operation is actually pretty hard to wrap your head around. Just between 2011 and 2013, Silk Road facilitated $183 million in total sales. But look a little deeper at that data. Over 9.5 million Bitcoins were transacted to reach that dollar amount. If you think about it, today, that much Bitcoin would be worth hundreds of billions of dollars. They had nearly 150,000 buyers and almost 4,000 vendors, trading primarily in illegal drugs. It was, for all intents and purposes, the Amazon of the black market. And the timeline of how this all played out, it seriously reads like a Hollywood true crime thriller. The site launches in February of 2011. Fast forward to June, and a massive article in Gawker completely blows the lid off the operation. This sparks a huge surge in traffic, but obviously, it also immediately draws the crosshairs of U.S. senators and federal agencies. The whole thing culminates in October 2013. The FBI finally shuts the site down and arrests Ross Ulbricht right inside a public library in San Francisco, literally swooping in to seize his laptop while he was still logged in as the administrator. Ulbricht was convicted and initially hit with 2 life sentences without the possibility of parole. However, the story didn't end there, as he eventually received a full presidential pardon from Donald Trump in January 2025. Moving on to Section 2, Mainstream Mania and Cycles of Explosive Growth. So we're shifting gears from the dark web to periods of just unprecedented financial expansion. Because here's the thing. Despite the massive Silk Road scandal, Bitcoin didn't die. The underlying market mechanics survived. And Bitcoin started to experience these monumental, highly cyclical bull runs that systematically transformed it from this weird, obscure internet token into a legitimate global financial asset. Just look at these growth cycles over the last decade. They are undeniable. Back in 2013, we saw a massive 730% increase. Then in 2017, we hit that insane 1,900% jump we talked about at the start. And then again, across 2020 and 2021, another 700% surge that ultimately pushed Bitcoin well over $64,000. These are not random blips on a radar. They are very distinct cycles, defined by intense upward momentum and rapidly shifting public narratives. The absolutely crucial takeaway here is understanding exactly why these runs happened. Each massive surge had its own unique economic engine. Back in 2013, it was actually the Cyprus banking crisis pushing regular people toward decentralized safe havens, mixed with early media buzz. In 2017, it was the absolute Wild West of retail initial coin offerings, or ICOs, pulling in massive crowds of everyday people. By 2020 and 2021, the entire narrative shifted to this idea of digital gold. We saw huge institutional investments from major companies like MicroStrategy, driven heavily by pandemic-era inflation fears. But notice the one constant element through all of this: Bitcoin halving. Every 4 years, the reward for mining Bitcoin automatically gets cut in half. This creates a strict, mathematically enforced supply scarcity that historically acts as the primary trigger for these massive market rallies. Section 3, the House of Cards and the FTX collapse. So as Bitcoin's value swelled, these massive, highly centralized exchanges naturally popped up everywhere to handle the sheer trading volume. The most celebrated, the absolute darling of these platforms was FTX, run by Sam Bankman-Fried. But in 2022, the core decentralized ideals of crypto violently crashed into a massive, centralized failure. The fatal flaw in Bankman-Fried's entire empire really boils down to one incredibly shocking foundational weakness. See, FTX had a closely affiliated, ostensibly separate trading firm called Alameda Research, which Bankman-Fried also owned. Well, in November 2022, a report dropped that revealed something crazy. 40% of Alameda's massive $14.6 billion in assets were actually just FTT tokens. What's FTT? It was a token created completely out of thin air by FTX itself. So Alameda's financial bedrock was essentially built on a coin invented by its own sister company. Let's walk through this catastrophic domino effect, because it brought down the third largest crypto exchange in the world in a matter of days. It was lightning fast. On November 2nd, CoinDesk publishes the piece exposing that incredibly fragile balance sheet. Just 5 days later, on November 7th, rival exchange Binance publicly announces they are dumping all their FTT tokens. The price instantly plummets, and pure, unadulterated panic sets in. The very next day, November 8th, a massive $6 billion customer bank run smashes into FTX, instantly vaporizing their liquidity. Customers simply couldn't get their money out. And finally, by November 11th, FTX, Alameda, and over 100 affiliated companies file for bankruptcy. 9 days, from the initial exposure to total, system-wide collapse in just 9 days. But how does a multi-billion-dollar platform disintegrate that quickly? As the bankruptcy process started under a new CEO, John J. Ray III, who, by the way, is the exact same guy they brought in to oversee the Enron liquidation, the really horrific truth came out. It turned out Alameda Research had a secret exemption from FTX's auto liquidation protocol. They literally used custom software to build a hidden backdoor. This backdoor allowed Alameda to secretly and illicitly borrow billions in customer funds to desperately cover their own massive trading losses. Ultimately, this created a staggering $8 billion black hole in FTX's accounts. The gravity of this entire fallout just cannot be overstated. Federal prosecutors didn't mince words at all. They flat out described the collapse as one of the biggest financial frauds in American history. Following some intense investigations, multiple key executives flipped and pleaded guilty. And eventually, in November 2023, Sam Bankman-Fried was found guilty of defrauding the customers of FTX and the lenders of Alameda Research. It was just a stark, brutal reminder of the immense risks lurking inside unregulated, centralized platforms. Which brings us right into our final section, the new era, 2024 and beyond. Amazingly, despite the absolutely catastrophic collapse of FTX wiping out billions of dollars and sending prices into a tailspin, the market didn't stay down for the count. In fact, by late 2024, Bitcoin not only completely recovered, it shattered its previous ceilings, ripping to new all-time highs of over $93,000. The landscape we are looking at today has fundamentally shifted. We've largely left behind that chaotic, unregulated past, the era defined by dark web black markets like Silk Road, insane retail ICO crazes, and billions vanishing into thin air and collapses like FTX. Today, we have very firmly entered an institutional present. In January 2024, the US SEC officially approved spot Bitcoin ETFs. This was a game changer because it meant traditional, highly regulated Wall Street custody rules were finally in play. And the result? Over $28 billion in ETF inflows by late 2024. Massive traditional players like BlackRock are now heavily involved. Quite literally, the Wild West is rapidly being paved over by Wall Street.
So as we wrap up this explainer, I want to leave you with a bit of a provocative question to chew on. Has crypto finally matured, or is history just sitting there waiting to repeat itself? With all this institutional adoption, the spot ETFs, and major traditional finance titans entering the arena, the market certainly feels more stable and grown up than ever before. But if the wild roller coaster of the last decade has taught us absolutely anything, it's that extreme volatility and totally unexpected betrayals seem to be woven deep into the very fabric of this technology. So what do you think? Thank you so much for hanging out and exploring this data with me, and I will catch you in the next explainer.